Put options explained for beginners. Aloha, ladies and gentlemen. My name is Brent. In this video, Put Options Explained for Beginners, I'm going to give you a very basic outline of put options, and most importantly, how by the end of this video, you will have the basic understanding of how to perform a put options trade that gives you a high probability of making money and a much lower probability of losing money. Let's get into it. What is a put option? In the most simple beginner terms, a put option is a legal contract regarding an asset, and it has an expiration date. For this video, we are going to be talking about put options on stocks, just to keep everything really simple and uniform. Put options can be used in a variety of other financial assets. You could use a put option on pretty much anything you can think about. For this video, as I mentioned, we're just going to keep it real simple, and we're going to keep it focused on stocks. So from this particular slide, what I want you to grasp about a put option is it's a legal contract, and it's regarding a specific asset, and it has an expiration date. Two people or parties are needed for the transaction of a put option. You need a buyer and you need a seller. The buyer is called going long a put option. The seller is called going short a put option. The buyer and the seller have certain rights or obligations. Although options are not rocket science, they do have complexities. And as a beginner, I'm going to keep it super simple for you. I'm leaving out a significant amount of detail that could cause confusion. And I'm just going to give you enough that would put you in a position to create a particular put option contract trade if you so choose to. And as you gain experience through real life, then you're going to be able to figure out more of the complexities easier. So instead of spending a lot of time with a lot of theoretical knowledge that does not necessarily make you any money, we're going to spend less time on the theoretical part with hopes to get you into the real life part, that whether you understand the terms and you have the definitions memorized, if your account is growing every month, the definitions don't matter. But if your account's not growing every month and you know all the definitions, something is the matter. Let's get into it. Let's take a look at it. So with put options in the stock market, you're dealing with increments of 100 shares of whatever stock. So one put option contract equals 100 shares of the underlying stock. The reason why this is important to know up front is that the strategy we're going to be talking about right now, which is selling cash secured put options. Cash secured means you're going to have enough cash in your brokerage account to fulfill your legal obligation in the time period of the contract if certain conditions arise. What are those conditions? Those conditions are buying the stock at a predetermined price. If the seller wants, if the contract buyer wants you to, or if the underlying asset is trading below the price that you said you'll buy it at. Does that seem confusing? Let's try to make it less confusing. We're going to take a look at this stock. I'm purposely not giving you the name of the stock because this video is about getting you to understand a particular strategy. It's not about proper stock selection. So everything is going to be blanked out. Let's get you understanding the particular strategy, and then you can find other videos that are online to help you with that. And sooner or later, I'll have that video to help you too. Let's look at this for the moment though. We see that this particular stock is currently trading around 11.20, right? It closed at 11.23. It's got a bid and ask, a little bit of a spread here. So let's just keep it simple and say it's around like 11.20, even though it's not, we're off by a couple pennies. Let's just say 11.20. This chart here is a representation of 6 months, and each of these red or green things here represent 1 day, right? Daily candlestick for 6 months. So we see over the last 6 months, it basically has gone up. It's gone sideways a little bit, but it's gone up, sideways, you know, down, up. So it's in this range. Now we are looking at selling a cash secured put option. So what would that mean? We're looking at this. We see it got as high as almost 12.50, and it got as low as almost getting close to like maybe 10.30 or something like that, maybe in the last month or so, right? Maybe that's 2 months time period, somewhere in there, right? Just very, very general. So let's say you have $1,000 in your account, and we're going to use this number of $1,000 because with the stock market and generally the financial markets, you need to have capital in order to really play the game. $1,000 is a very low amount. Now let's say you're listening to that and you're like, Brent, I don't have $1,000. Well, my friend, you have to figure it out. You have to figure out how to get money in your account. And you can do it. So just do it. $500 to $1,000 is probably your entry level to be selling cash secured put options. If you're super resistant to figuring out how to get $1,000 in your account, if you can't figure out how to save $1 a day for 1,000 days, then you need to be watching how to on a different video. So figure out how to get $1,000 in your account. Once you have $1,000 in your account, you'd be able to look at a particular trade like this. Now you see the stock has been trading all up here. Let's look at selling a cash secured put option at $10 right here, which would mean that if the stock stays above $10 in our given time frame, then more than likely we're not going to have to buy this stock, unless for some reason the buyer of the put option that we sell says, you know I could get 10.75, but I just want you to cash me out at $10 anyways. Hardly, very, very low chance of happening, but it is in the contract that the buyer of the put option contract could potentially have you fulfill the obligation even if the stock is trading above the strike price that you choose to sell it at. Highly unlikely, but it's a possibility. More than likely what's going to happen is that as long as the stock trades above $10 by the end of your contract period, you're going to keep the money that was paid to you from the buyer. The buyer pays the seller money. You'll keep that money, and you'll keep your $1,000, and the person with the 100 shares will keep their 100 shares. If by the end of the contract period, if it trades below $10, then you keep the money paid to you for selling the contract, and you buy the 100 shares at $10. Could we make any money from this? For this, keeping it simple, let's look at a 9-day expiration time. So you see how this is 2D, 9D, 16D, all the way down here to 611. That's how many days that this contract is open for. Let's keep it short, keep it simple. We'll look at 9 days, right? You see this up here, it says strike. As we go down here, we see a number that increases. This is talking about the stock price itself. So let's look at here at $10, move over here. You see there's two numbers here, the bid in the ask, we're going to be looking at the lower one. So for a 9-day period, we could potentially get paid 4 cents per share. How many shares are we dealing with? 100. So $4 before commissions. We could potentially get paid $4 for a 9-day commitment, and we're either at the end of 9 days, we're either going to buy a stock for about $1.20 discount from where it's currently at now, or we are going to not buy the stock and just keep the $4. We keep the $4 regardless. Now, what's the chance of this happening? Well, there's more sophisticated ways to look at it, but this is put options explained for beginners. So we're going to keep it real simple. We'll just look at the probability of profit right here. The probability of profit is telling me, with all things kind of being equal at the moment and remaining the same, that there is a 93% chance that this stock at the end of 9 days will trade above $10, and I will keep this $4 and not have to buy the stock. If there's a 93% chance that the contract will expire worthless, that means there's a 7% chance that I'll have to fulfill my obligation and buy the stock. If so, that's totally okay, because I have the $1,000 to do it, and the stock has been trading up in here. So if we're buying it down here where we could have bought it several months ago, then that is we're basically getting a discount. We're potentially getting a good deal. Now there's a little more into it, right? There's got to be proper stock selection. You don't want to be buying an Enron. If you don't know about Enron, it's a pretty fantastic story. You can look it up on another day. You don't want to be buying something that's losing value and going to be losing value. So obviously proper stock selection, which is a topic for a different video, needs to be in there. But that's it, ladies and gentlemen. It's really that easy. So what would be a very easy way to select a stock? So first of all, you have to look at how much money you have in your account that you'll be able to fulfill that obligation of buying at least 100 shares, right? So you have to look at your bankroll. How much do you have? If you're dealing with $10,000, obviously you have a lot more choices. If you're dealing with 500 to 1,000, you have less choices, but you still have choices. You still have choices. The other thing is you want to pick a stock that you wouldn't mind owning the rest of your life if you had to buy it, and at a price that you wouldn't mind buying it at if you had to. So very, very basic, a stock that you wouldn't mind owning the rest of your life if you had to. So you want to think about, let's say you are 30 years old. You might live to be 100. What company has the potential of outlasting you, of at the minimum going on for 70 years at a price that you'd be okay with buying it? I have some other videos on this channel that talks about some of the benefits of this particular strategy. You can check those out. And let's get back to a warning. The stock market has a way of taking your money when you open yourself up to excessive risk in the market. This has happened to me a number of times, even though when I first started learning about trading, which was sometime around 2007, one of the first things that was told to me is that trading is 10% knowledge and 90% emotion. Think about that. All these definitions that we're talking about, these terms, these jargons, I got to understand what this is and all that, all these numbers, 10% of your success is going to come from that. 90%, the majority of your success, is not going to come from what you know. It's going to come from here. It's going to come from how you use what you know under pressure and under extreme euphoria. The risk that you'll be constantly dealing with, more than likely, is a subtle form of greed slipping in. You might not realize it, but you might be tempted to start deviating from things. So what do you do about that? As I mentioned, 10% skill, 90% emotion. Greed is not a financial issue. It's an issue of the heart. It's an issue of emotion. No matter how much you understand about the theories and all these different formulas and all this stuff about the stock market, your overall success in the financial realm has to do with how well you manage your emotions. So not only do you have to learn the jargon and that type of stuff, to figure out how to manage your emotions. Thank you very much for your time. I hope this was of a little bit of value, and to me it was a lot of value because I had the wonderful opportunity to make another video for you and to learn from it. Isn't that awesome? It's awesome for me. I don't know how you feel about that, but regardless of how you feel about that, I got something free for you. Get a free copy of 3 underused tactics to transform your financial results. These tactics, all 3 of these tactics, will give you direct and indirect edge over controlling your emotions. You guys have a fantastic day, and if you're interested in that, check it out here at ihavesuccess.com. Bye-bye.